Ladies and gentlemen, welcome to Creating Tailwinds Podcast by FlightPath Financial with your hosts, John Urbick and Jared Adams. Join us today as we discuss the power of infinite banking. And here we go.
Well, John, welcome again. Moving along on the episodes here. Just had a cool experience, able to go do Think Tank. Back, travel completed. Here we are. How you doing today? How's your day going, John?
Doing fantastic, Jared. What a great couple of days. Huh? Jeez, it was.
I am as being in the South and seeing some of the sunshine start to shine through here and get into those low 70s, maybe a little 60s overnight. You're talking my language. I'm loving this.
Yeah, I don't know what I'm going to do with all this vitamin D, though, right?
I know, right? Right?
The sunshine down in Florida. Oh, my gosh. Orlando was awesome. Interesting. I was driving back with Antoinette from Orlando. We were listening to a couple different finance channels that she allowed me to listen to with our private time.
Right.
But it's just amazing. You just want to talk back into the radio, and you can't. But gosh, I just wish people going out and leasing cars. They were talking about leasing cars, for instance, and that it could be a good option. And I mean, shoot, Nelson covers this specifically in his book, where and building your own system. If you're going to lease a car, you have no equity. You've got nothing but pure expense. You're basically paying off the depreciation for whoever owns that vehicle, and they're making a profit on top of it. So it's probably the least efficient way of owning an automobile. And then he kind of marches through the different examples, but Nelson talks about in his book, you've got method A through E, right? And A being the worst, which is the lease. And then he talks about the banking method where you can go and get a loan from a bank. And that's better because at least you own the car, but all that interest you're giving up, Jared, right?
Sure. Well, I mean, that's a perfect spot to start. We left up completing part 2 of Nelson Nash's Building Your Own Bank book. We left off in part 2. Here we are now creeping into part 3. Perfect kickoff, John. Do you want to keep going? I'm loving where you're going with that. You talked about the lease, the bank method, the cash method, the CD, and then the IBC. Each one of those in themselves could take a big, long, verbose discussion. But how would you describe those? What do those mean to you?
Well, just carrying on from there, Jared, the cash method is what people who are responsible with the money think that this is the most efficient way to do it, the best way. Hey, I'm paying cash, I'm going to be done with it. We've covered this before, but we give away all opportunity costs with our money when we do that. So cash method is better than the bank method, is better than the lease method, but they're almost co-equivalent between the cash and the bank because you're effectively doing the same thing. It's just where the money's coming from. It's always a step down to zero. And you look at you've seen those loading docks, for instance, and they have those concrete steps going up to the platform. Oh, yeah. That's what it's kind of like doing. If you're doing the bank method, you're buying buying the money from the bank, and you're up at the top of the loading deck, and you spend that money. You got to go all the way back down to zero and start all over again to finance the next one. If you're doing the cash, you're unloading all your own capital. You've got no more, and you've got to save over those period of 3, 4, 5 years to buy the next one. So it's just what direction you're coming, but you're always working to zero.
Yeah. So B and C there, the bank method versus the cash method, those to me seem very, very similar in the ending point, like you said, right? You're still working to zero. If you're looking at let's say a $12,000 car and you're going to save $1,000 a month, that 1 year later, you'll be able to pay cash for that car. Okay, great. Right. Good job saving. And then you get to that year mark and you fork over that $12,000 for the vehicle. What's the opportunity cost you gave up of the ability to use that $12,000 anywhere? So you took that 12, handed it over to the car dealer, left with a car, and now you've got that car to show, that depreciating asset, and you drive away with it. What could you have done with that $12,000 elsewhere? That's the way I think about the cash method. Same thing with the bank method. If you loan that $12,000 at the beginning of the year from the bank, and now you pay it $1,000 a month, and you pay it back, Well, you ended up at zero, and we both know banks pretty well, John. They're not going to give you a 0% loan. Even if
No, they're
they
not.
even if they're at the dealership and tell you, "Yeah, well, we're offering 0% financing." Well, that's because they cooked it into the cost of the vehicle.
Yes,
They're
they
not
are.
selling these things off the lot for free, and they do have quite the amazing business, and the American consumer is really the one that pays.
100% right. 100% right.
If you look at the B and the C with the cash method, you know, B and C, cash method, bank method, both pretty similar. What's a different way? How else would you structure that?
Well, you've heard people talk about, well, I'm going to be smarter and I'm going to just get a CD. I'll put the money in a CD because they're going to make interest in the CD. And as
Yep.
they, over time, they'll at least have something. So, yeah, clearly that would be better than the cash method, but still, it's not that much. What are CDs paying today anyway?
Sure.
But you and I have talked about this at length about how you could do this if you structured inside this transaction inside of an IBC contract. Gosh, if you put the money inside of an IBC contract, your money never leaves that contract. It continues to grow year over year. You get increased death benefit, which comes with cash value guaranteed because the interest on the money grows every year, guaranteed. And on top of that, you've got dividend income in case the company performs better than expected and they have a rate of return that they're going to distribute to all shareholders, which would be you as a policyholder.
Yep.
So yes, you're capitalizing on both interest, like you got on the CD, but you also get dividend income. You are the bank. So it's a huge difference between, an IBC account method versus those other four. They're
That's
they're
right.
some are better than others, but clearly the clear winner is the IBC method. What
That's right.
what are your thoughts?
I couldn't agree with you more. The name of the chapter is how to start building your own banking system. We're not talking about the physical four walls of a bank, but we're talking about a conceptual product that gives you control of your finances, of your funds, and you get to determine where that funds go, and then not only where they go, but how you pay them back. And so
Yeah,
if you're able to allow those funds to collect an interest and collect a dividend while having access to it, that's where it separates itself from the cash and the bank method, where the bank method you borrow and you pay it back, the cash you save, and then you go back to zero. With the IBC method, you're having access to your funds while they're growing. So you get a perpetual upswing of building your warehouse of wealth. That's what Nelson would call it. Is you're not only having access to use your funds, but you're able to use them and deploy them while they're growing in the background with that uninterrupted compound growth.
yeah. No, unfortunately, President Trump is not returning my calls. He was saying his favorite word is tariff. I'm trying to get him to say IBC because once he learns about this, he's gonna put the whole country into infinite banking policies, I swear. But
Right,
every contract that we do, Jared, it's like starting a new business, right?
right.
Because
Yep,
you got startup costs, just like if you had any other business, a coffee shop, you got to buy product, you got to turn the lights on, you got to buy your people, you got to pay rent, all of those things before you ever sell one stitch of goods or provide one bit of service. You gotta capitalize it first. And for those people who don't, they say, hey, I can't afford this stuff, it's too expensive. Can you start with a few $100, two, three, $400 a month
that's right.
that you're putting somewhere else? You
Yep,
could. And just by the discipline of that savings, as you're building up these cash values inside your IBC contract, you can go buy a car down the road with this, and now you're in business.
that's
It,
right.
it
Yep,
it's just a function of time. How long is
that's
it going
right.
to take you? Some people can do it right away. Some people it's going to take a little longer. But the net effect on
Yep.
your finances is pronounced in time. It truly is.
I completely agree. I think, it really doesn't matter how many zeros you have behind these accounts as long as you get them set up and get them rolling. Like the benefits that are reaped from seeing these, and these aren't the instant gratification style of need for turnover. Like that's why the grocery story or I'm sorry, the grocery store story exists in Nelson's book. I know we talked
Yeah.
about that a couple of podcasts ago, but it's all about
Yeah.
how many times do we have to turn the peas over on that shelf before we're making a profit. Well, that's not too different from allowing these contracts to get set up and mature. That doesn't mean that you can't use the store while it's growing and while you're building it. You still can use it, but it hasn't quite yet hit that turnover rate where the peas off the shelf have equaled the investment you put into the shelf. So it's an important thing to remember, but if you're looking at it through the lens of, well, I don't want the 6 or 7 year startup cost. I can't afford that. I would argue you can't afford not to for what you're going to
Yes.
pay and for
Yes.
what Nelson would say is, we've already talked about 34.5% of every dollar you pay in interest. What happens if you recapture that and you keep it in your wealth warehouse and you keep it in your possession? I mean, the benefit alone of just eliminating outside debt, that one aspect could be huge, and there are other multiple facets. So, would you agree with this is how you expand the system to accommodate all different types of income?
Absolutely, absolutely. And I mean, to distill it down to the essence of what we're talking about, Nelson talks about in his book. You're going to hear us talking about what Nelson said because everything you need to know is contained inside these 92 pages. It's just,
So true.
it's not hard. You know, he says the essence of what the infinite banking concept is all about is recovering the interest that one normally pays to some banking institution. It's
Yep.
no more complex than that. We can get into all kinds of side discussions, and some of them are pretty interesting. But really, you don't have to be sophisticated at all. The difference between a very sophisticated person and a non-sophisticated person doing IBC is exactly nothing. I mean,
That's
it,
right.
it is there for all of us to utilize. You know, you,
Yeah,
you want to walk. Yeah,
we were talking about the engineer, right? The
right.
engineer wants to uber overanalyze these things. Okay, great. Yep, it's there for you too. And then you've got the farmer that's in the fields working real hard, paying for every piece of equipment that they can find just to
Right.
make ends meet and to grow the business. Yep, this works for you too. And everybody in between. Sorry, I
Yeah.
cut you off. You were talking about the growing.
In our example, the city holder, they earn bank interest, but the key thing that people ought to take away is that the difference with the IBC contract is the owner gets interest and dividend
Right.
income out of this
Yep.
thing. And that is just, I mean, dividends aren't guaranteed, but only been paying them for over 100 years.
Yep.
So it's a pretty reliable marker as to what you can expect. And it takes the life insurance companies time when you get a life insurance contract, people think all these life insurance companies are making all this money. It is a very thin market for them on a lot of money. It takes them 13 years to amortize the cost of acquisition of one policy.
Right.
So it's not like the insurance companies are getting rich. What Nelson would talk about is you've got similarly situated people wanting to work toward their mutual benefit with each other.
That's right.
That's really, when you boil it all down, it's like-minded people doing business together and covering risk, with a much larger pool of money than all of us would be able to do if we were doing it by ourselves. It's a
Yeah.
it's a tremendous, tremendous concept.
It really is. And that was something I actually pulled away from the think tank recently was the concept that, with a whole or a permanent product, whole life or permanent product, the most risk that the insurance company assumes is day one that you sign that contract. And every day that moves
Absolutely.
away from that, their risk decreases, knowing that they've
Yes.
had more time to build up their assets and build up their capabilities to pay you for someday the guaranteed amount that they will pay you. That's the
Yes.
part of a whole or a permanent product. There is a guaranteed payout at the end. And then yet you compare that to a term insurance where the highest risk is the last day before that term policy ends, where the
Yes.
first day, lowest risk, and every single day that goes on until the last day of that term contract, until that term contract expires, where the highest risk is day one of not having term insurance, there is zero risk for the insurance, and there is $0 you have in your pocket. So, you talk about the insurance companies getting rich off of which products?
Yeah. Yeah. Right. Well, it was interesting. We had this discussion, you and I, with we were invited on Barry Page's podcast. Shout out to Barry. But sure, I mean, insurance is all about offloading the risk. And so everybody, because money has been fast and loose for so long, and everybody is win, win, win. Especially younger generations, younger than you and I even. I'm
Yep.
61 years
Yep.
old here. Shoot. But no, the point is they don't know what a severe downturn looks like. These
That's right.
markets can turn, you know?
Oh yeah.
And so when you put your assets inside of a life insurance contract that's protected from, the storms of the economic storms that come with business cycles, you're
That's
in a
right.
phenomenal position to take advantage of opportunities when those opportunities present themselves, and they will. So by pushing every last nickel into the market, by pushing every last nickel into a 401k or an IRA, for example, might not be the most, the most direct strategy to accumulating wealth. It just
It
it
certainly
just has
takes on all
proven to
the
be.
risk.
It
You
does.
you
It
know, if
does.
if you look back into the days of pensions and whatnot that existed in the various industries throughout the country, who took the risk on at that point? Well, the company had to go invest those funds so that at the end of your career, they were able to pay you, you know, a set amount for whatever that might be, a monthly, a yearly income. So who took on the risk? Well, the insurance company that was protecting that asset or the company, one of those. Well, what's our current setup today? Who's at all the risk? Who is the risk marker for your 401k and your Roth and all those funds? If I know and theoretically it wouldn't tank to 0%. There'd be a lot of other different issues besides just a tank to 0%. But if it falls 30%, who absorbs that? Who's at the risk?
That's a ton though. I mean, 30%.
Yeah.
Think about it.
Yep.
Think about it in terms of food. If you had enough food, just enough food, enough calories, 2,500 calories a day or whatever the number is, over the course of the year. Let's say you had just enough for the course of the year, and you had that in stockpile, and somebody came back and took 30% of your food. You're gonna be really hungry, or
Yep.
or you're gonna get really thin. You don't have
That's right.
enough. You
Sure.
know, so
Right.
what we're talking about with infinite banking is just a smart strategy of where you're building the foundation. Sure, you can go invest in the market. Sure, you can go do all these things if you see an opportunity. But the operative word is opportunity, and opportunities come to where the cash is available. Opportunities will find you if you have the means to participate, and that drills right down to one of Nelson's hard and fast rules. His number one rule: don't be afraid to capitalize your system. So when we look at putting money into one of these things, it's not an expense. It truly is not. You're
Yep.
building you're building a basin from which you can capitalize when opportunities happen. And if you're going to make tax free, essentially, if built correctly, a tax free rate of return inside one of these things, and you have an opportunity that you can make 50 or 75 or 100% on your money. Would you rather have 5 grand sitting there or 50 grand sitting there? Well,
Yep.
I know what I would want.
Yep.
And these are precise. And how long would it take you to achieve those same things, in a mutual fund, which is
Yep.
going up and down and up and down. And they're taking fees from you along the way. And when you're done with your investment, you take it out, you got to pay taxes and capital gains.
Yep.
So,
I mean, as a God-fearing Christian, I hesitate to throw around the word evil, but goodness, if that doesn't sound like evil. I know Carlos Lara would agree. I know he spoke
yeah, he
about that
would.
at one point about, basically, will you remain a slave to the bankers? You know, what does that look like? Are you going to be a slave to the bankers for the rest of your life? And what do we so willingly turn over in power and control in actual dollars and cents? To hear, the Carlos Lara speak about that was pretty amazing.
Yeah. Well, you hate to go down, I don't want to go down a dark path, but part of why I have my antennas up on some of this stuff is who controls the money supplies? The central bank in conjunction with the federal governments do
Sure.
control the money supply, but who's actually out there contracting and expanding the money supply through fractional reserve banking. It's the Federal Reserve, and the Federal
Right.
Reserve is a private company. It is not a federal entity at all, even though it's got a federal name on it. It is not. Federal Reserve, no, it is not. And
Right.
who sits on those boards but the bankers, the heads of these large banks, which are profit centers.
Right.
So you've got the wolf looking after the chicken coop. It's
That's right.
just there's a
Yep.
problem there.
And
So
truly the only way to take back that control or to not be a slave to bankers is, at the root of that, you have to take away their ability to create money. Are they creating
exactly
money
right.
by printing it? Are they creating money by using the fractional reserve banking system? Both of those create money out of thin air that never existed before and devalue our currency. So
Right.
if you are able to take away their ability to create money out of thin air, that's really the root to being able to no longer be a slave to the bankers. And I don't mean to demonize or cause evil on any of them personally. I would imagine they have pure interests, but it's really hard not to sit back and see all the damage that's been done ever since the beginning of the Fed. How do you look back over the last 100 years and see what inflation has done, or what the value of the dollar has done, and not just be a little suspicious of where we are or where we're headed? I know you could, like you said, we don't need to go down a dark path. That's not the intent. The intent is, are you in control? Do you know where your funds are going? Have you capitalized your system?
Yeah. No, you're 100% correct, Jared. And I believe I strongly believe in personal freedom. I think it's foundational to being an American. I mean, it's foundational.
Yep.
But you cannot have freedom without economic freedom. And when they control your money, they control you. And when they control you, you are no longer free. And so, really, I'm nothing more than a warrior for money. No, I want to give it back to people. I don't want to take their money. I want to show them how they can effectively take back and control their own money. That's
That's right.
theirs. It's not
That's
it's
right.
not the banks.
Yep.
And so the whole idea behind IBC, if you follow the process, is you want to fund these contracts. You don't be bashful about it. You want to put as much as you can into them. And I'm not saying that just to say it. It's really true, because the more money you have available to you, the more you'll have available when opportunities present themselves. And
That's
so,
right.
on the other hand, if you put money into a contract and then you borrow it out for opportunities, you do, as one of Nelson's hard and fast rules, is you want to put the money back. You want to make provisions for recapitalizing what you've borrowed from the insurance company. Because remember, your money has never left. You're using other people's money. You're using money from the general funds of the life insurance company, which has a collateralized lien against your cash values. So it's very safe, it's very secure, it's very private. But you want to treat it with respect. You've got to treat your money with respect. And if you do, you'll do far, far better off than you will just throwing it into a bank account in the Bank of Main Street, where you're going to get 0 point nothing for your money. And then you'll pay
Well,
taxes on the 0 point nothing and interest income.
to follow up what you're saying with borrowing the money from the insurance company, I thought only rich people borrowed other people's money and got their money to work at the same time. I thought that was only for the rich,
Isn't that an amazing thing that the little guy can do that too?
right? Yep. How many zeros you have behind it doesn't matter. You can still set these accounts up. Pretty amazing.
Yeah. So you got
Well,
one of these
go
things.
ahead.
I was going to say, Jared. So we got one of these things built. You've set up your first one, and Nelson would say, "At what point do I start another one?" Well, Nelson would
That's a
say,
good question.
when you can't put any more into it, and you've got excess funds to put into a checking or savings account,
Right.
that's time to start another um, contract. Well,
So we could break that down of two different ways, right? You could say, everybody's got their operating account that money's come into, and you got to pay for food and pay for bills, and everybody's got that. But if your savings account is constantly growing, then you might consider building another branch to your bank.
If you've paid off all your loans on your policy and you've paid off all of your premiums and you still have money sitting in the Bank of Main Street, you might consider what that looks like.
Absolutely right. Nelson said it takes 20 years for somebody to free themselves from the banks. If you're disciplined over a 20-year period, you can capitalize the system of policies, and you are going to have all the money you need to run the banking affairs of your life. Your personal economic model is confined, and you are the chief executive officer of your bank. So
Love that.
well, what happens though if you're what if you're a guy like me? You're 61 years old. I mean, I don't. Am I going to have 20 years? Gosh, I hope so, but maybe I won't.
Right.
But
Well,
does
you've
that mean
got
I shouldn't do it?
no, not at all. You've got really two answers on two different pathways that you get to pick from. One is you are still an insurable, your life is still insurable. Now the cost of insurance is a little bit higher for a 60-year-old than it is for a 40-year-old, but the amount of money that gets viewed as your cash value in your policy, that doesn't change any. So absolutely, you can open a policy on yourself. Now, what usually happens as you creep into the 60, 65, 70, and the cost of insurance does get a little high, the other way you can look at it is there another insurable life in your family, in your household? Do you have a wife? Do you have kids? Do you have grandkids? Any of those lives are insurable assets, and I know we're going to talk more about those as we dive further. But the short answer is no. You're not too old for this. You're never too old for this to start growing your warehouse of wealth to take over the banking function in your life.
Well, how about this? If you want to just give money to your kids,
Yep.
you're capped. I don't know, it's 23,000 bucks a year or something like that, and then you've got to pay a gift tax, right?
Yep.
What if you're 60 or 70 or even 80 years old and you build one of these things saying,
Yep.
well, okay, I'm not going to capitalize it for 20 years, perhaps, maybe not, but you will have the banking function. That's still going to
Sure.
be there. So you can
That's
use
right.
it in the same way. But then you're able to pass on as a legacy to your family or your whatever is important to you. You're going to
That's
be
right.
able to pass that money along to somebody tax free.
Yep.
And if you try to take $1 million and pass it along to somebody, they're going to pay a lot of taxes on that money. But with even an insurance contract, you're going to take that $1 million and perhaps the death benefit payout will be 1.2, 1.3 million bucks later in
Yep.
life. So
That's
you're
right.
moving all that money tax free with a kicker. How nice is that?
That's right.
Talk about tremendous gift to give to somebody you care about,
Yep.
whether it's your spouse or your kids or some charity that's important to you,
That's
or
right. Yep.
a friend who's been with you all your life. Who
Sure.
knows?
That's
There's
right.
just so many powerful things you can do to sidestep the savages of inflation and taxation. Life insurance does things that nothing else can do.
That's
And
right.
how wonderful is it that we can make a bank out of it and we can use the money while we're living when we really need it and then leave a legacy after we're gone. People who do infinite banking don't look, to 5 years down the road. They look generations,
Right.
three, four
Generational.
generations down the road.
That's right.
Because if you teach your family to do this, they will never be in need of capital from the banks. Again, how great would that be if you could, you know, 50 years after you've graduated, your family is banking with the money that you started with, and they
Right.
never need a commercial bank.
That's right.
It's just a phenomenal feeling.
I mean, you could go down a couple of different pathways here, but what comes to mind is if you're giving, $1 today and you're getting, let's say, $1.50 return, if you're looking at it, 10 years down the road, that might be a little undershooting. 50% turn in 10 years is pretty low. But
Yeah.
what does it look like 50 years from now? Every 10 years you're supposed to turn over and double the account, right? So if over the course of 5 decades, what have you done? What have you done over the course of 10 decades when your children's grandchildren are working from the same $1 that you gave that was not taxed on the way out, given to the next generation? They built and grew it, given to the next generation. What does that look like? Do you think for every dollar you gave now probably looks like 10 or 20 down the road? Maybe even more than that. I mean, it's borderline amazing, but you're spot on with saying that, infinite banking folks think generational. They're not looking at 2 years, 5 years, maybe even 10 years down the road. They're looking generational.
As you know, Jared, I'm writing a book, and
Yep.
this exact topic is in that book. And people think that they're going to be able to pass on all this wealth. Your assets are growing, and you're looking at the multi-million-dollar legacy that you're going to leave your family. Well, it wasn't long ago, irrespective of political affiliations, but it was during the Obama administration, and they were talking about changing the estate law, which is what they wanted to do, because $2 million was plenty of money to retire with. So anything after $2 million would become fully taxable. They were that is in discussion, and it's still out there. We do not know what's going to happen with tax law between now and tomorrow, let alone 10 or 20 or 30 years. I do have a pretty high degree of confidence what's going to happen with life insurance contracts, though. So the money that I got in there, pretty darn solid.
Sure. Yep.
So.
Well, we've done a great justice for part 3 of Nelson Nash's Becoming Your Own Banker. Tune in next time where we keep pressing through the book and even maybe a couple of other surprises along the way.
All right, Jared. Have a great evening.
Thanks.
Bye-bye. We'd like to thank you for tuning in to today's episode of Creating Tailwinds podcast with your hosts, John and Jared. As always, we welcome your questions and critiques. You can reach us through the Contact Us tab at flightpathfinancial.com. Remember, it's all about how you think. As Nelson Nash has said about infinite banking, give it your close attention, and it can make a radical improvement in your financial future.